All right. So I'm having a look here at the historical view of the Federal Reserve balance sheet. And this is a chart that's somewhat hard to find. I saw this on a channel called Game of Trades. This is one of my favorite technical analysis channels. And he was talking about velocity of money and talking about the Fed balance sheet going up and percentage of GDP. And this is on the Federal Reserve Bank of St. Louis website. And so this is just a historical chart that comes like straight from the Fed, and they had a 23% of GDP. The Fed balance sheet. I know there's a lot of people that think the Fed has never done anything like QE before or never put any stuff on their balance sheet before. Like this is some new thing that they're just trying now, and that's completely not true. The Fed has did that around World War One a bunch and had this kind of peak and a crash here. They did that all around in the 1920s, the whole roaring 20s. They were just pumping the balance sheet and the stock market was going crazy. And then they had this down to now, and now they're doing it again. And they're just pumping up the balance sheet. And this kind of peak here at the Great Depression was 23% of GDP. And that was not during a war or anything like that. I mean, there's bumps in the balance sheet on World War One and World War Two here, but um, but those are smaller ones that level themselves out a little bit better. But this is like a parabolic run up to the Great Depression here, and that is what I wanted to compare to what we have now. On this chart, uh, I noticed that it says the Great Depression is like 1941 ish on this timeline, and that's not right, but it does say down here, ignore the time series because it doesn't match, because they have like monthly data and annual data. And I mean, how hard is it to fix the numbers? But okay, let's go to the next thing and take a look. So 23% of GDP is where the Great Depression happened. And yes, they did run the balance sheet up. And yes, this is the same thing as QE. And yes, they have done QE before, and it wasn't called QE. I don't know what they called it, but they were buying all kinds of securities and everything that whole time. And this is the this is the Federal Reserve website, and this is their current balance sheet. Let me uh, let me pull this guy. So so prior to the financial crisis, here this is 2008, and the Fed balance sheet was, where are the numbers here? Was less than a trillion. And then during the financial crisis, and it was in September for a few months, September for like 2 or 3 months, they went from less than a trillion to more than 2 trillion. So they more than doubled the balance sheet in a couple of months here during the financial crisis. And then it just kind of gradually kind of worked its way up, and then they tried to bring it back down and it didn't work out too well. And now they're on kind of another parabolic trajectory here. And this is during, that's March. So the crash started in February. So yeah, I mean this is right during this first leg of the crash. The balance sheet is going up, and I would like to point out something else here. A lot of people say that you can't have like a downturn in the stock market until the Fed starts reducing their balance sheet. But it looks like it's going parabolic, but really it just went parabolic to March, and then April, May, they're leveling it off and trying to reduce the amount that they're printing here. So they are leveling it off a little bit. But the balance sheet now is 6.7 as of May 5th. And let's take a look at GDP. So last year's GDP came out a little bit more than 21, and the projection for this year is down a little bit. Still looks like above, uh, around 21 somewhere. Just say like 21. So let's do some quick math here. 6.7 divided by 21 is 30, about 32% of GDP that we're at right now. Balance sheet to GDP is around 32%. And what was the number from the Great Depression? 23%. So the Great Depression was 23% of GDP, and let's see, and now we're at 32-ish. That's kind of generous because I think the balance sheet is actually higher than that as of today, and the GDP estimate is probably lower than that right now for like this quarter or whatever. But I wanted to look at this chart and show, where was it? September, right here. So this is the housing bubble kind of coming down, and this waterfall right here towards the end of the housing bubble is the financial crisis crash. And this is where they blew up the balance sheet. This is where the euro dollar system freaked out. And I have it labeled as the euro dollar contraction here, but this is where kind of the international banking system kind of broke, and the Fed first started blowing their balance sheet up. And then over this whole bull run, they've been kind of gradually increasing their balance sheet. So it went from less than $1 trillion to more than $2 trillion just during this little fall right here. It more than doubled here. And then they slowly were increasing it over this whole thing. And then, let me check the dates out again. Yeah, there it is. So, let's see. When did they started the quantitative tightening, what, in 2015? They were trying to bring it down. 2015, and then the beginning of 2018. So we can check that out. 2015, about halfway up the bull market, they started trying to tighten it, and then we get some nonsense here. Get a contraction underneath the bull line, and what was the other one? Around the beginning of 2018. So that's Volmageddon, right? Around the beginning of 2018. Yeah, so they started tightening it here, and we got this contraction, and then they started tightening it here, and this whole Volmageddon and 2018 crash was during that tightening. And then where does this go? September of 2019. So it was out here. Yeah, right here during this parabolic up move here, September 2019. Yeah, so the Fed balance sheet versus the moves in the stock market is pretty close. I mean, you can see the contractions and the expansions in the monetary system just kind of reflected in their balance sheet, and you can see it on the stock chart where you get these contractions. And that's a really cool thing to look at, is the angle of the Fed balance sheet increasing or decreasing, and then looking at the contractions that you get in the stock market chart. And it's when they are decreasing the balance sheet, usually, that you get the contractions, and then this little increase here is that little run up to the blow off top. And then this huge increase here is during the huge crash that we had. So it's not correlated where up means that the stock market's going up, because this whole section here where they went parabolic up is during that crash, and now they're tapering it down on this bull run. So that's a good look at the Fed balance sheet relative to the financial crisis, kind of when the first time the world monetary system broke down, and now the second time that the world monetary system broke down now. And yeah, I guess, 23% of GDP was Great Depression. We're at whatever it was, 32, 33% now. And That's how the monetary contractions and the Fed balance sheet relate to the stock market. And yeah, GDP looks like it's coming down. I don't have a velocity of money chart, but you see the whole bull run where the stock market was going up, the balance sheet was going up, but velocity of money has been going down the whole time. So like the valuation of the stock market um, relative to the velocity of money right now is way out of whack, and that's what happened in the Great Depression. Also, is you got the balance sheet way up, and the stock market way up, and the velocity of money way down, and it looks very similar. The shape of this bubble looks very similar, and the fundamentals of this bubble look very similar to the Great Depression. And so I've been using that one as a model to try to model the backside of this thing a lot. And also the Nikkei bubble I think is a really good one too. I mean, people don't realize that the Fed was doing QE during the Great Depression. Their balance sheet was really high, and I just wanted to point that out in this video. And it's not the first time that America has done that. The entire QE program, like they did the whole QE program during the Great Depression, and they were trying to stop the thing from coming down during the Great Depression. It's the same stuff that they're doing right now. They did it. They've done this whole thing before. And also, if you look at the Nikkei bubble and do this kind of model on the Nikkei bubble, it looks very similar. And it's the same thing with Japan. Like the Bank of Japan was increasing their balance sheet, and then they're doing crazy QE and trying to stop the Japan bubble, and it collapsed all the way down, to the bottom of the bubble, and then they were doing QE after that, and it was like a 20-year bear market after that in Japan, and they've been trying to do QE for 30 years, and they had deflation for for like 20 years. So that's just kind of a look at money printing and the balance sheet and the contractions, and you get to a point where you can't really print your way out of it. Like once the bubble pops and starts coming down, I mean, I've looked at a bunch of them on this channel, but you get this just pattern where the monetary contraction happens. Like no matter what they try to do, it happens, and you end up winding down off of this bubble, and that's what I expect to happen here over the next, you know, I don't know, couple years or 20 years. Japan, well, the bubble in Japan was only like 2 or 3 years. The Great Depression bubble was the same, 2 or 3 years. So that's a pretty normal kind of asymmetrical crash off of a sovereign debt bubble. And we've seen different bubbles than that. If you inflation adjust uh, like around like 1966, there's an inflation adjusted stock bubble there that is completely symmetrical and really wide and everything. But this looks like an asymmetrical crash just from this first leg here. It looks like the Nikkei, it looks like the Great Depression, and so yeah, if you go check out my other videos, you can see this kind of model on top of all those different bubbles, and then you can see a bunch of technical analysis. I get in here and try to look at what's happening now. So here I was doing some Bollinger Bands and stuff today, which are pretty cool, but the main point is that you have these tangent lines for where the angle of the bull market increases. You have a bull market tangent line. And so we have a 12-year tangent line off of the financial crisis, and we have a higher level tangent line here off of the 2018 crash. And what happens when you're coming down the backside of a bubble is you break the tangent line, and then you go up and you back test it, and then that terminates that tangent line, and this is a wave. So this is one mathematical wave from where this tangent line originates to where this tangent line terminates. It's a wave, and the tangent is just the end-to-end sort of average line of that wave. And that's what a bull market wave looks like, and an end-to-end tangent line on a bull market wave looks like. And once you terminate it, then you go down sort of to the next level of the bubble, and there's another longer term tangent line that's less steep, and this is a 12-year bull market wave, and this is the tangent line. We're reacting along this tangent line now. So when you get to these tangent lines, usually if you break them and you come up and backtest them like this, like you're about to terminate this kind of a tangent line, but it doesn't say anything about when that's going to happen. I mean, if you go look at like the Nikkei bubble, some of them are just a quick little backtest and break it, like this one, or there's one on the Nikkei that just like grinds and grinds and grinds and grinds and grinds along the tangent for months and months and months until it finally reverses out of there. So it's expected to kind of terminate this tangent at some point on this bubble, but the timeline, it doesn't really project the timeline just based on this model. But I've been using kind of the cyclical and inflation data model, which is like a 3 to 4 month window right now that we're in a credit contraction, and probably about here actually. It's kind of the window to try to terminate this tangent and get down while we're still in a credit contraction cycle. So I've been drawing this model, and it's just kind of dragging out late enough that I don't know if and when this is going to happen, but it looks like the next 9 months after this cycle is going to be inflation and growth cycle, and then get an inflation with down growth cycle, and then get an inflation with growth cycle again. And that is just going to be kind of a bullish. Probably this one would be up and down and then bullish for like 9 months after this cycle. It would be just kind of bullish and then up and down and then bullish. And yeah, so that's just the idea of the cycles and the model. And I sometimes get into the technical analysis of like daily movements and everything like that, but usually I just do the macroeconomics and the cycles and the shape of the bubbles and just try to pin down how we are coming down off of this bubble and where our support lines are. Because this line down here is like a floor for the bubble that goes back to, well, can't see it on this one, but this goes back to 1982. It's like a 40-year floor on the whole bubble. And that's basically the downward target of the bubble where you could unwind this entire bubble. And that usually takes like 3 years or something, like in the Great Depression and the Nikkei. It takes about 3 years to unwind these tangents and then get down to the floor. And then once you get down there, you can find out if you're going into a steeper trend line or Japan went into a deflationary lower trend line, or if you just stick on the trend line once you get down there. But that's kind of the bubble shape and outlook for how you build up a bubble with increasingly steep bull market trendline waves, and then how those waves terminate down on the backside of the bubble when you break and backtest and terminate those waves. And then and then I was looking at the MACD and all that sort of stuff. We're getting another little kind of dip and a swing here. So I was pointing out the MACD in a previous video here, where once you get up here above this sort of zero line on the MACD, like this is bullish kind of territory where swings are going to be an uptrend in the stock market up here, and once you get down below it, those swings would be downward movements in the stock market. And so most of the stock market, like 90% of the time, you're actually above the zero line and you're getting bull market kind of activity, and then you just briefly go down below it. And so we went way, way, way down below it back here in this crash on this peak. But now this activity here, since after this, this is like the max divergence on the MACD here, and I was projecting it to turn over here, and it hasn't turned over. And now the trend line has gone to the bullish side, and I don't know if we're going to get a reversal on the MACD to back to the red, like a momentum reversal here. But if we get a momentum reversal up here, this is still in the bullish kind of territory, and it would be, well, I don't know where it would go. It depends where it goes. So if you get a reversal and it stays kind of on the bullish side, then it would be kind of a little peak on a way up. And if you get a big reversal down here into bear territory and it bounces kind of on the bear side, then that would be like a downward movement. So that's what I'm trying to track right now is where are we on this tangent line, and where are we on the movements here? And if we don't terminate this thing like right now over the next month, and I mean that down movement should be during the contraction cycle, like after you switch into the expansion, that should be bullish. And so, I mean, I think right now the projection for a down move would be to kind of just make like a bit of a down move, I guess, towards the end of this thing, and then I guess maybe a 9 month kind of run across here, which would, maybe we don't terminate the tangent now. Maybe that's going to be our tangent for the next 9 months or something like that. And we do like a super long, like 9 month thing like that. I don't know. I don't know what to expect here, because it didn't turn over. It didn't turn over enough yet to get down to another level, and I don't know if it's going to be able to do that unless the economic data changes from what it looks like. But I don't think so. I don't think so because I saw some updated data just like 2 days ago, and the data for this quarter looks like way bigger contraction than expected, and the data out for the next 3 months looks about the same. So what was this video even about? Oh, we were talking about the Fed balance sheet. Yeah, okay, sorry. I just kind of went off on a model thing that I wasn't even trying to do on this video. So please hit the like button to help me out with the YouTube algorithm. And this is not financial advice, just kind of working on the bubble model. And I think we are on the backside. I mean, obviously, look at this thing, man. Look at this like gentle little bull market activity here, and then look at this reversal into the biggest freaking gash in the history of the stock market or whatever. Like, this is the backside of a bubble, and this is what it looks like when you're ripping down and terminating these wave tangent lines that you've been building up for 2 years and 10 years and 40 years. That's what it looks like, and it looks like that on the Great Depression and the Nikkei. You can go check out my other videos, but this is the backside of a bubble, and it should be a bear market until we get down to the bottom of the bubble. We're still up at the top of the bubble here. I mean, this is just kind of the top bull market line on the top of the bubble, but the bull market line from 1982 at the bottom, the base of this bubble, is 40 years long, and it's quite a ways down here. I think it's around 1200, and maybe it would be if we got down there in whatever 3 years, maybe it would be at 13 or 14 or something like that on this slope. So that's probably overdoing it a little bit. And if you're still watching, thank you for hanging out and listening to me talk about the shape of the bubbles and the Fed balance sheet and all that stuff. So this is nothing new. Like, the balance sheet is nothing new. That's what the Fed did in the Great Depression. That's what Japan did in the Nikkei bubble. And yes, they did the same stuff on the way down. They try to stop it. Every government tries to stop it when it's crashing. and it never works. The bubble comes down and it unwinds with these patterns every time. So this is the kind of stuff to expect here over the next few years, is just unwinding down off of this bubble. And where you terminate the tangents is a little bit more difficult. I mean, it could be 1 month or it could be 9 months away when we terminate this tangent line. And so we just have to kind of figure out where we are. And it's a pretty tricky trading environment here, especially if you're near the tangent like we are now. It's just a high risk of just terminating this thing and ripping down, just like we did on this one. When you terminate that tangent, you can get a big rip down the bubble. And we've already gotten a huge rip, so yeah, and this is really late, so I don't expect a huge rip down here just because of the time scale and how late this is and where we are on the MACD. We're on the top side of the MACD now. Usually, if you're gonna get a low rip, the MACD will just turn over down here and kind of do this thing, and you just go down, down, down if you're down on the bear side. But we're up here on the bull side of the MACD, and it looks like it's going up, and it's just kind of flattening out. I would expect this thing to go to the red side and get at least a little turn down, even if we do kind of get a bull thing. Like, I mean, it could even just do like a little turn down like this, and then it could do a really, really boring, like 9 month long move, like under the tangent line. That's just like kind of sideways or something. I mean, the Nikkei did a lot of sideways stuff like that. Um, but I would not expect it to get back up out here somewhere. I mean, uh, yeah, I think that's pretty unlikely right now. But we'll see what happens. We'll see what happens. I've been trying to track this thing, and it's been tricky. So thanks for watching. Cheers.